Be careful with how people promote dividend investing. A lot of dividend investors mean well, but their theory is flawed. I think the sales pitch they use is get paid while you wait. The idea is that dividends come in while you're living your life. Not exactly like that. One stock that dividend investors used to always put forward was Johnson & Johnson. They always compared Johnson & Johnson to the S&P 500, Johnson & Johnson in the red, S&P 500 in the blue. They would say, quote, they had returns of 3,800% over the last 30 years. It's a dividend king that's managed to increase dividends for over 62 years in a row. So one thing to notice is that they anchored the date to 1991. Unless you invested one time in Johnson & Johnson back in 1991, you're not seeing the results that they're showing here. That person is literally the lottery winner. Dividend investors have stopped using Johnson & Johnson as an example, as its stock has fallen to the same price 5 years ago, back in November 2020. But in fact, it's even worse. If you are 40 years old and you bought Johnson & Johnson stock 2 decades ago, when you were like 19 or 20, you would now be losing against the S&P 500, the US index. And that is with dividends included. There are a few inescapable facts. Number one, if you're buying individual stocks, very high chance, 97% chance that over time you will lose to a passive index. Two, companies go through cycles of start, growth, plateau, death. It's impossible for companies to stay in growth mode for decades on end. There's a few companies that have stayed around, but if you look at the top businesses 30 years ago, you'll notice that they've all changed. The benefit of a basket of companies in a passive index is that when that company eventually dies, it's moved off the index and a stronger contender is put in as a replacement, as opposed to buying individual businesses or stocks where you're always worried about what stage of the life cycle they're at. And finally, dividends aren't free money. For example, if you have a stock that's paying a 4% dividend, that is literally a forced withdrawal of 4%. It is as if you are selling 4% of your holdings every year. The difference is that instead of you deciding when to sell, the company is making the decision for you. So if you only needed to use 2%, it's too bad. You're selling 4%. It's a persistent illusion because the number of shares you own doesn't change. You just get the dividend. You get a dividend, so you think the value stays the same. But no, the value of the business has declined by the value of the dividend. It's worth less. When a company distributes a dividend, what they're saying is that they can't find any use for the money they have in the business. So instead of using it and investing it and growing the business, because they can't find a good way to do that, they return the money to shareholders. A high dividend is literally telling shareholders that they can't find a useful purpose for the cash they have. Having said that, it's very difficult to find anything that doesn't pay a dividend. Every ETF probably pays a little bit of a dividend, but the point is you don't want to invest for dividends. You want to invest where it's the best return for your money. And if a dividend is paid out, it's paid out. But you're not focused on maximizing dividend yield or dividend payout, because the odds are pretty good that you're lowering your total rate of return. Many dividend investors mean well, but they really don't know what they're talking about. Learn the lessons about money that your parents and teachers couldn't tell you. Download my free newsletter linked off the bio. Good luck. Take care.